We have a mix of CEOs from the big exchange groups like Nasdaq or Euronext, and then other types of market participants such as regulators, market makers, brokers, the buy side, and then other exchange officials. So we'll do like the fireside chat type of thing, but then we'll also have panel discussions about various topics, and we tend to have people that are not quite as senior on some of those panels so that we can kind of get into the weeds on some of them. We've had people like Adina Friedman from Nasdaq and Doug Sifu from Virtu and Stefan Bujnov from Euronext for many years at the conference. But because we also like to have some kind of topical panels, you do see the mix of people kind of change a little bit from year to year. And you're right to point out the session that we did on the future of retail brokerage, where we had a gentleman from public.com, we had someone else from Webull, speaking with our equity analyst, Andrew Bond, about just what's happening with their companies right now, what they're seeing with respect to their clients' activity and what they're thinking about for the future. Another session that I was really excited about and had been planning for months and months since we saw some of these announcements with Google and CME and then Nasdaq and Amazon Web Services was a panel session on exchanges moving to cloud technology, moving their matching engines to the cloud. And we had someone from AWS, we had someone from Nasdaq, and then someone from Jane Street, the major prop trading firm, just talking about the implications of those kinds of moves and some of the pros and cons. So those were a couple of sessions that were, not the sort of thing that we necessarily do every year. We have talked a little bit about retail brokerage in the past, but because retail has become such a bigger component of the U.S. equities market in the past few years, we thought it made a lot of sense to drill a little bit deeper into that this year. Hand-wringing about the post-Brexit environment for European markets was definitely pretty prominent. Things have gotten more complicated, more costly. And it was interesting because in that particular session, we had someone from the UK Financial Conduct Authority, we had someone from the AMF in France, the national regulator there, and then we had two market participants from Virtu and Cboe. And the regulators were very much painting a picture that was not as negative, right? That yes, Brexit happened, but the differences in the regulation between the UK and the EU are pretty minor right now. On the grand scheme of things, we're still the same on 9 out of 10 things or whatever it winds up being. And then the market participants kind of dwelled in on the 1 out of 10 and saying, well, that's making my life a lot more difficult now, right? And even one of the regulators on the panel, I believe it was the gentleman from the AMF, said something like, it's kind of like there's been a divorce and now you have to have, one house where mom lives and one house where dad lives and the kids stay there a little bit of the time, but you're spending twice as much money on rent or housing or whatever. And that's what we've seen happen with all of these different trading venues that used to be located in the United Kingdom and now have to have essentially versions of it in Amsterdam or some other city in the EU, and all the market participants have to connect to them all. The other session in which that came up was the fireside we did with Stefan Bujnov from Euronext, and he's spoken at a lot of our conferences over the years, this one and then the one we hold in London in the spring. And he definitely has made it clear that he's not happy that Brexit happened, just kind of as a European and a citizen and a citizen of the world. But as the CEO of Euronext, sees it as an opportunity. So we spent some time talking about that. And I would say that was one of the major themes. The other thing that we spent a ton of time talking about was just the potential huge changes that are set to happen for U.S. equity market structure regulation. Gary Gensler, most of your viewers will be familiar, has kind of telegraphed that there are some pretty big changes that are going to be proposed soon from the SEC. And so, throughout the day, whether it was potential changes to tick size, potential changes to retail order routing, we kind of delved into that in a fair amount of detail throughout the day. And I think if I had to kind of summarize it, I would say market participants who were among our speakers expressed understanding about some of the concerns or a lot of the concerns that Gensler and other policymakers have put out there and are driving a lot of this change, but they're worried that it's going to be too much change too quickly and that things can go wrong when you get that ambitious and try to change that much. I think most people in the room, whether they were on the stage or in the audience, follow things closely enough to have realized that the SEC didn't seem to be ready to outlaw payment for order flow. Like that was the conversation and the fear immediately in the aftermath of the GameStop craziness, all the meme stock stuff that we saw happen in early 2021 and the congressional hearings that followed in the spring. But since then, I think the signs coming out of Washington have been that, well, probably not going to ban payment for order flow, but they may do a bunch of other things that would make not necessarily payment for order flow, but the status quo for retail execution. So payment for order flow is part of that for a large portion of the retail orders out there. But it's really the other things that go along with that the order is sent to a wholesaler and internalized off exchange rather than being exposed to a broader array of market participants. I think it seems like all the things that the SEC is considering and is probably going to be proposing soon might make that outcome or that the way that retailers get handled now more rare than it is today. And retailers might wind up interacting with the wider marketplace a little bit more than they do today. This notion of having to expose a marketable retail order to an auction. This is something that Gensler talked about in a speech in June, and everybody expects the staff will propose as part of a rule sometime soon. But beyond that general idea, it's really unclear how that would happen, and there are a lot of question marks for how that would be structured. What would the rules associated with that be? How long would the auctions take? Who would participate? Would there be fees and rebates allowed like there are for continuous trading on the exchanges? Would there be a maker-taker or a taker-maker system? And I think particularly from the folks who are involved in that retail execution ecosystem today, the retail brokers, the wholesalers, the arguments they made, not surprisingly, and I think they have some merit, are that the system does work pretty well now. There are certainly ways that it could be made better, and I think the SEC is trying to do that, and that's the argument that they would make. But the worry is that you take a system that mostly works well, and maybe you make it better, but maybe you don't, right? Like if the auction isn't designed the right way, and regulators are not in the business of operating markets, they're in the business of regulating them. So I think there's just people that are worried that, like, what is this going to look like? What is it going to be? Is it going to add latency? Is there going to be information leakage? Are these orders going to wind up not getting executed? And then would the retail customer wind up with a worse outcome? So just a lot of question marks and the worry and uncertainty that goes along with that. People seem to agree that the one-size-fits-all tick size regime that we have, in which every stock has a 1 penny minimum price variation for quoting, is not fit for purpose, and that we should change that. And that moving towards something else, maybe it's the model that you see in Europe, where there are several different buckets with different tick sizes that correspond to the various liquidity characteristics of different groups of stocks. You see things like that happen in other parts of the world as well, such as Japan. Moving toward that type of system would make sense, because the 1 penny is good for a bunch of stocks, but it's bad for the extremes. There are a bunch of stocks that are widely thought of as tick constrained, meaning that they would trade at narrower than a penny if the rules allowed exchanges to accept sub-penny and display sub-penny quotations. And then there's another set of securities that are extremely high priced that would trade more efficiently if the increment were actually a little bit wider than 1 penny. We've come a long way since 2008. We had that first one in the teeth of the financial crisis, just a couple of weeks or a few weeks, if I remember correctly, after Lehman Brothers went bankrupt. So we were all kind of holding our breath to see, will people even show up? Unfortunately, they did. We don't want it to get too big, so we deliberately keep it to a certain size. We like to have senior representation. We like it to be manageable enough so that people can speak with one another, and it's really high quality networking, and the room is small enough that it feels intimate.